Assalamualaikum and hello everyone. You're watching Principal Malaysia's Q4 2024 Market Outlook. I'm Nadia, your moderator for today's session. And here's our dynamic duo of investment experts, Mr. Lee Chung Hong, CIO of Equities, Principal Malaysia, and Mr. Jesse Liu, Chief Investment Officer, Fixed Income, Principal Southeast Asia. We saw some major changes in the third quarter of this year. In early August, the market dropped sharply but bounced back later in the month. This was mainly due to investors reacting to the Bank of Japan's sudden policy shift and weak US economic data that raised concerns about a possible recession. Uncertainty grew as market expected possible quick interest rate changes and noticed ongoing economic weakness in China. On that note, Chun Hong, could you please share your thoughts regarding the equity market in the third quarter?
Okay, thanks Nadia. Thanks. I'm here again for fourth quarter review. So again, the third quarter 2024 is a very interesting quarter to me and I think to most of the investment participants. Why I say so? I mean, in mid of July 2024, the MSCI World actually hit the all-time high. Malaysia, the FPM 70 also hit an all-time high sometime in mid-July. And subsequently, like you mentioned, in early August, there's a big drastic move caused by BOJ and a few other economic data. So on the 5th of August, or what they term it as Black Monday, so we can see that those markets, especially the developed market, that has been propelling to the new high, especially those related to generative AI. And because of the low interest rate before the hike by BOJ, I mean, everyone has been borrowing money from Japan and buying into this market and crowding in all this market, thinking that nothing will go wrong. Okay? But of course, BOJ hiked the rate hike higher than expected, coupled with the weaker employment data, and also over the weekend, there's a tension in the Middle East, and this caused a very big move. And why I say interesting quarter, I mean, usually when this kind of sell-off, you expect currencies, emerging currency will be the one being sell off the most. But if you remember on the 5th of August, Malaysian ringgit actually appreciated closer to 2% in one day. So it's very unusual. Okay, second thing that we find it very interesting is the volatility index or VIX index. It hit at 1.65 level, third highest in history since global financial crisis and also recently COVID-19 sell-off. And usually when the sell-off, I mean, dollar index is supposed to be the one that people are hiding in. But again, like I say, dollar actually weakened. And gold price is another currency that people will hide also. But again, it was down. And if there's a recession fear, base metal like copper, nickel, zinc should see a sell-off as well. But it was well behaved during that period. Okay, so generally the currency gold and US dollar are supposed to be strengthened, but it's not behaving that way and it's the other way around. So that's why we think that this sell-off is technical in nature. So everyone is unwinding the Japanese yen carry trade. So they just sell off whatever asset they've been using to borrow, to buy into, and they sell off. And everyone sell at the same time. So the window is a bit narrow. That's why the move is quite drastic. I mean, why I say drastic, like SK Hynix, one of the memory name in Korea, in 1 week, they give up the entire gain of the stock price, because of the unwinding of this carry trade. And now, subsequently, like you mentioned, MSCI World has started to recover and hit an all-time high. And this time around, it was led by emerging market and subsequently China on the back of the higher than expected Fed rate cut of 50 bips. And of course, recently there's an easing measure announced by the Chinese government. So this led to the MSCI to hit an all-time high again.
Okay, thank you for your perspective, Chung Hong. Now, Jesse, let's hear your take on the fixed income market in the third quarter.
Right. So if I were to just backtrack a bit, we account for the last 9 months, you have the first 6 months being quite bearish for the bond market, largely because you have very strong economic data coming out of the US. But coming into third quarter 2024, you then had some weaker data, especially in employment data from the US that came in below market expectations. And that is, like what Chun Hong mentioned earlier, started the decline in equity prices. But bond prices, because when we saw weaker data come in, the initial reaction would be that bond investors would start to price in some form of lowering of interest rate in the US. So the pricing actually was quite dramatic as we enter into third quarter. And because of that, we saw actually bond markets performing fairly strong. If I were to then compare and contrast between the US dollar bond markets around the world versus local currency, I think the US bond market performed well on a US dollar basis, but the emerging market bonds performed even better, largely because the currency part of it rallied substantially. I think everyone knows that the ringgit rallied quite a lot for the past few months, and that contributed even more alpha for local currency bonds, especially over here in Asia.
Thank you so much, Jesse. Okay, on to the next one. Chun Hong. The equity markets look to approach the end of the year in high spirits as the Fed has now begun its rate cutting cycle, prompting discussion about broadening market leadership. What are the new investment trends considering the current market dynamics?
Yes, Nadia, you got it right. Things are getting better and better, especially with the rate cut. Based on historical pattern, when the Federal Reserve start to cut rate and we are not entering any recession, but equity generally will post a positive returns. And in terms of the strategy wise, nothing has changed. So in equity, we pay up for growth. Okay, so we reckon that the global tech are here to stay in the longer term. Of course, like you mentioned earlier, it's broadening up from not just tech, but to other sectors as well. This is healthy development for the rally to continue. If not, we will continue just in narrow market. If anything happen, it will burst quite fast and the impact can be quite substantial. So where can the money go? So I mentioned earlier, so the emerging market and China start to lead the market to the new time high. We reckon this segment has suffered a bit in the last 5 years because of the high interest rate, especially in ASEAN space, for too long, and affected some of the consumer patterns. And we reckon that ASEAN also has suffered for political uncertainty. I mean, right now has kind of tailwind. As you know, that Malaysia just finished or entered their G15 on November 22nd, then followed by Thailand in July 2023. And early this part of the year, Indonesia just concluded their election as well. So these are kind of tailwind, and obviously right now the government will focus on the economic reform, just like what Malaysia has done. And because of that, Malaysia market is one of the best performing market, along with the strong ringgit. So for year to date, Malaysia and MSCI is one of the best performing globally. We hope that 2025 can be repeated, but let's see, because we are quite positive going to 2025. Yep. So again, the country or the market can generate growth will be the one that attracting the global fund flow.
Okay, this one's for Jesse. So the Fed has started the long anticipated easing cycle with a 50 BPS cut during the September FOMC meeting. So Jesse, what's your take on this, and what are there any possible signals we should be paying attention to?
I think right now over in the US, inflation somehow has taken some form of a backseat at this point in time. The trend has been coming already since late last year, and I think right now what is more focus is the employment conditions over in the US. And as you recall, the US Fed has a dual mandate responsibility. One part being inflation, the other part being unemployment or employment environment. So in that sense, given that inflation is trending lower, it's important for the Fed to make sure that, given that they are at a high interest rate environment, means that it would still be restrictive in the economy over there, and henceforth, if you have any decline or weakening in some of the economic data, they would need to make those adjustments to make sure that they achieve that soft landing they're looking for. What is probably key right now is to understand that even the Fed is not committed to what they are looking in terms of the policy rate movement moving forward. Most of the central banks around the world are still data dependent. They are still observing what kind of fast data will be coming out and make the adjustments accordingly. So I think to me, the key point is really to observe more and more of the economic data, the unemployment data that's coming out moving forward, and that should guide investors in terms of where they think policy rates can be.
All right, thank you, Jesse. Now let's discuss the ASEAN region. The region has so far delivered strong performance despite the market uncertainties, supported by stable macro condition. Corporate earnings for the next 12 months are also expected to remain resilient. Chung Hong, what do you think are the structural opportunities that you see which could sustain the market sentiment?
Okay, I think in ASEAN nothing has changed fundamentally, but because of the high interest rate environment for the past 2 years, it affected slightly on the consumption base. And also China being our largest, not the largest, one of the largest trade partners, has not inflated as well. I mean, it's not growing, it's weaker than expected. So for the past 4 years, so ASEAN in a way are affected, especially those that sell the commodity to China, in particular Malaysia, Indonesia as well. And also at the same time, late last year, ASEAN are hit by this El Nino, I mean the dry spell. So as you all know, the agriculture sector is the largest employer in some part of the world and some part of this country. So farmers has seen a deteriorating income. So because of that, they also can't spend more than they usual be. Okay, that's then follow that. Like I mentioned earlier, the political uncertainty for the past 2 years. So investor or global investor don't like uncertainty. So until they can see who are the government, is it strong enough? What's their focus? And I can see that Malaysia, when the Bandan government came in and come out with all this series of reform they announced, the market has tried to perform relatively better compared to our peers. And also the other thing that has changed also, I mean the interest rate has pivoted to a declining trend. I mentioned earlier, when the Fed started to cut rate, equity market tended to perform better. That's why ASEAN, since mid-July, are one of the best performing markets and continue to do so on top of the stronger currency as well. So the existing fundamental story for ASEAN still remains the same: young demographic, highly domestic consumption. I mean, more than 60% are domestic consumption, followed by all these China plus one strategy that have been employed for the past few years. Things are still in place, and things are actually turning for the better for ASEAN. So we are in particular more excited in the fourth quarter and first quarter. Generally, ASEAN would do the best in these 2 quarters, and I think it's the time to revisit again ASEAN and also Malaysia as well. Yeah.
Thank you, Chun Hong. Now, Jesse, turning to the ASEAN bond market, are you anticipating any major shift in ratings? Additionally, how do you perceive the demand and supply dynamics evolving in the Malaysian bond market in the near term?
So I think ASEAN bond market continues to be a stable one as a region. While observing the policy rates, we can see it has been stable for most of the year, with only minor adjustments over in Indonesia. And Indonesia adjusted largely because it is to follow the US in a way, and also to ensure that that lowering of their policy rates would ensure a stable Indonesian rupiah as we move forward. So we are looking at a region whereby there is strong growth, very strong economic performance. And when I look into this kind of market, it instinctively would mean that you've got probably a very stable credit market. I don't think there's going to be any surprises in terms of credit rating, whether it's on a sovereign side or even a credit downgrade trend in the domestic economy in these countries, in an ASEAN country. So I think we are bullish still at this point in time for the ASEAN region fundamentally. And given that we are at a high rates environment, we are still in a high rates kind of environment. The markets here looks attractive as compared to other global markets.
Okay, thank you, Jesse. As we wrap up today's discussion, let's get some advice for our clients regarding to the asset allocation for 2024. Chun Hong, let's begin with you, and then we'll hear from Jesse.
Thanks.
Yep.
So just to recap, so don't think we are entering any recession in the near term. So, and also we are quite positive going to 2025, but nonetheless, volatility is here to stay. So it's advisable to stay diversified, and also because the interest rate is pivoting to a decline trend, so it's good to stay with yield and at the same time buy into quality growth as well. So I think this mixture of strategy will be the better approach in this volatile market.
I think what's interesting today is that if you look into both US dollar and also local currency bonds, the US dollar and local currency, they're running on different dynamics. So number one is that the US dollar ones is running on a yield reduction kind of a cycle, whereby if there's more rate cuts coming in by the Fed, that would provide outperformance in terms of duration for bond markets. Same time, I think when we are looking into the US currency, barring any black swan events, this would also mean that the US dollar might likely weaken further as these rate cuts come in. So with that, you contrast it to the local currency bond markets, whereby number one, they have been enjoying a lot of performance out of the FX part of it, largely because of the US rate cut. But the second part is that a lot of these economies over in emerging market, they haven't really started their rate cuts yet. Some of them had one or two cuts, but a lot of them hasn't really started any rate cut. So I would say the dynamics are a little different from both these markets. But emerging market seems to be one that is very interesting right now. If I were an investor to consider both US dollar bonds or local currency bonds would definitely be something that I want in my portfolio, largely because you can gain alpha or performance through not only interest rates, but also on the FX side of it.
Thank you, Jesse. With that, we have come to the end of today's session. Thank you both, Jesse and Chun Hong, for your valuable perspectives and insights. We hope that the analysis by our experts have provided you with useful takeaways to navigate the financial landscape in the coming months. Thank you and see you next time.